Are you seeing signs of inflation beginning to increase?
We're seeing very substantial inflation. It's very interesting. I mean, we're raising prices. People are raising prices to us. It's being accepted. I mean, it's not.
Inflation is a big concern for everyone right now. Individuals, companies, investors, and even politicians. It's been one of the most discussed topics over the past year to 18 months. In this video, we're going to go through a hierarchy of different investing categories and see how they perform during periods of inflation, all according to Warren Buffett. At 91 years old, Buffett knows a thing or two about inflation because he's lived through it multiple times. I went through hours of interviews with Warren Buffett while researching for this video. All I ask in return is that you hit that like button. Seriously, that's all. Okay, and maybe subscribe to the channel if you haven't already. Now, let's get into it. The worst investment to have during a period of inflation is cash. Warren Buffett isn't the only investor who dislikes holding cash during inflation. Fellow billionaire Ray Dalio has also been very vocal about his dislike for cash, famously saying, "Cash is trash." Here's why. During times of inflation, the cash you have sitting in your savings account, or even tucked away in a drawer at home, loses value every day, every week, every month, and every year. One of the biggest takeaways I want you to have from this video is that, as an investor, you need to think about your returns in real terms. The math behind calculating your real return is simple. Let's say your investments return 10% a year. Sounds great, right? Not so fast. It really depends on the inflation rate. To calculate your real return, you need to subtract the inflation rate from your nominal return. So, if inflation is 7% and your investments return 10% that year, your real return is only 3%. Not nearly as exciting, right? This is why cash sits at the bottom of Buffett's hierarchy, because your return on holding cash is essentially zero. Over time, inflation quietly eats away at your purchasing power. Next up on the hierarchy, just above cash, are fixed interest rate bonds. These investments are usually considered very safe by traditional investing standards. But Buffett would argue that they're not as safe as they seem once you factor in inflation. Here's what that means. The current yield on a 10-year U.S. government bond is around 1.8% as of when this video was made. If you purchase a 10-year government bond today, you're locking in a 1.8% annual return for the next decade. Now, if inflation averages 4% over those 10 years, which isn't far-fetched considering the latest reports showed inflation at 7%, your real annual return would be negative 2.2%. That's still better than holding cash, but it's a long way from being a good investment.
You know, if we dropped $1 million of cash into every household in the United States today, everybody would feel very good, except the people that invested in things that were denominated in dollars. And,
Exactly. It's important to note that people who own fixed-rate debt, like government bonds, lose during times of inflation. On the flip side, people who borrow money in a long-term structure at a fixed rate are actually the winners during inflation. An example of this would be people who use a mortgage to buy a property. In December 2020, I purchased a house and was able to lock in an asterisk 30-year fixed-rate mortgage at 2.8%. This means my interest rate will remain the same for the next 30 years, and my mortgage payment will also stay exactly the same for that entire period. That's a great position to be in during times of inflation. Here's why. Inflation slowly erodes the value of money over time. As each dollar becomes worth less and less, inflation effectively eats away at the real value of the mortgage debt month after month, year after year. So, I get to repay my mortgage with devalued dollars, which makes inflation work in my favor. Unproductive assets.
If you own a home, though, with a very large mortgage and you have incredible inflation, it wipes out the mortgage, and you've still got the home. I mean,
in Weimar, Germany, they gave you the mortgage back at the end. It was very interesting. That's the one thing they did right.
Next up on this hierarchy is what Warren Buffett refers to as unproductive assets. These include things like asterisk gold, silver, and other precious metals. Now, these aren't terrible to own during a period of inflation. In theory, as the prices of goods and services rise, the value of these assets should at least asterisk keep up with inflation. However, Buffett points out that unproductive assets won't actually increase your purchasing power either. They simply hold their value. They don't generate income, dividends, or any form of cash flow. Let's listen to Warren Buffett explain this in his own words.
I would say this about gold. If you took all of the gold in the world, it would roughly make a cube 67 feet on a side. So if you took all the gold in the world, we could have a cube that went down there 67 feet, 67 feet high, and that would be the whole thing. Now, for that same cube of gold, it would be worth at today's market prices about $7 trillion. That's probably about a third of the value of all the stocks in the United States. So you could have a choice of owning a third of all the stocks in the United States, or you could have a choice of owning that little block of gold, which can't do anything but kind of shine there and make you feel like Midas or Croesus or something of the sort. Now, for $7 trillion, there are roughly 1 billion acres of farmland in the United States. They're valued at about $2.5 trillion. It's about half the continental United States is farmland. You could have all of the farmland in the United States. You could have about 7 Exxon Mobils, and you could have $1 trillion of walking around money. And if you offered me the choice of looking at some 67-foot cube of gold and looking at it all day, maybe touching it, fondling it occasionally, and then saying, do something for me, and it says, I don't do anything, I just stand here and look pretty. And the alternative to that was to have all the farmland in the country, everything, cotton, corn, soybeans, 7 Exxon Mobils, just think of that, add $1 trillion of walking around money. Maybe call me crazy, but I'll take the farmland and the Exxon Mobils.
Let's move on to the next category of investments in our asterisk inflation hierarchy. Now, these investors aren't just looking to keep up with inflation. We want investments that can outperform inflation and generate a real return over time. This is where what Warren Buffett calls productive assets comes into play. We all know that Buffett made his fortune by buying stocks and entire businesses. But, according to him, not all businesses are created equal. Next up in the inflation hierarchy are productive assets. Average businesses share a few common traits. One of the biggest is that these types of companies require a large amount of additional capital, which is just a fancy word for cash, to keep operating and growing. Example.
Unfortunately, most businesses will not come out well in real terms during inflation. Their earnings may go up a fair amount over time, but they're compelled to put more and more dollars into the business just to stay in the same place. And, the worst kind of a business is one that makes you put more money on the table all the time and doesn't give you greater earnings.
So here's a simplified example using a real company that will hopefully prove the point. United Rentals, ticker symbol URI, is the world's largest equipment rental company. They have a pretty simple business model. United Rentals buys equipment typically used in construction projects, such as bulldozers, portable restrooms, and heavy-duty trucks. United Rentals then rents out that equipment to construction projects for the short term, usually for the length of each project. Obviously, this equipment doesn't last forever and needs to be replaced every few years. Let's say, for simplicity, that each bulldozer the company buys costs $1 million. Over its lifetime, that bulldozer can be rented out to customers and generate $1.2 million in sales. A nice $200,000 profit, but let's imagine inflation is 20%. This means that the next time the company goes to buy another bulldozer to replace the old one, it now costs $1.2 million instead of $1 million. See what's happening here? The company isn't able to take any money out of the business as profit. All the money that United Rentals earns in profits has to be poured right back into the business to replace equipment. Now, I don't expect inflation to hit 20%, hopefully, and United Rentals is a great company. But this example shows the challenge capital-intensive businesses face during inflation. One quick story before we move to the next. Characteristic of businesses you should avoid during inflation. Warren Buffett's partner and friend, Charlie Munger, once gave a quote that perfectly sums this up. There are 2 categories of good businesses. One is the business where the whole reported profit just sits there as surplus cash at the end of the year. You can take it out of the business, and the business will do just as well without it. The second is one that reports a profit, but there's never any cash. It reminds me of the used construction equipment business of my old friend. He used to say, in my business, every year you make a profit, and there it is, sitting in the yard. There are an awful lot of businesses like that, where just to keep going, to stay in place, there's never any cash. The next trait of average businesses that you want to avoid are companies that don't have pricing power. The best way to explain this is to look at a company that does have pricing power. Apple. Apple has such a loyal customer base that many customers will pay whatever price the company sets for its iPhone. If someone wants a new iPhone, they're not switching to a competitor just because it's cheaper. Now, contrast that with a company that has little or no pricing power. For example, a company that manufactures plain white t-shirts. That's all it makes. No designs, no branding, just plain shirts. This company has zero pricing power because customers only care about the asterisk lowest price. If the company raises prices even slightly above competitors, people will just buy from someone else. In an inflationary environment, this kind of company really struggles. The cost of materials, labor, and shipping are all rising, but the company can't raise prices. The only thing that isn't increasing is the price they can charge. See now why inflation is so tough for companies without pricing power. Now, let's move on to the next investment category on our hierarchy: productive assets. Great businesses. I know, very clever name. Here's another example. Remember the earlier business that spent $1 million buying a bulldozer? Let's say instead, our friend John uses that same $1 million to develop a software product, something that helps YouTube creators make videos more easily, just like before. Let's say John makes $1.2 million. His first year, $200,000 profit. Great. But wait, it gets even better. Let's assume inflation is 20% again. This means John can charge 20% more for his software this year than last year. That $1.2 million in sales becomes $1.44 million, all thanks to inflation. But the best part, John doesn't have to spend another $1 million to rebuild the software every year. Once the software is developed, it only needs small updates or maintenance. This is the opposite of a capital-intensive business. John's software company is what's called a capital-light business, because it requires very little reinvestment. To keep operating, that means John can actually take profits out of the business, instead of constantly reinvesting just to stay afloat, unlike the equipment rental company earlier. If you want to find a business that performs well during inflation, look for the exact opposite of the mediocre businesses we discussed. You want companies with low capital requirements, businesses that don't need to keep pouring large sums of money back into operations to grow. Often, these are companies with very strong brands like Apple, Coca-Cola, or Buffett's own See's Candies. Other great examples are tech and software companies that don't rely on owning lots of physical assets like factories or inventory. Think of Microsoft, Facebook, Meta, or almost any software-focused company. Once the software is built, the reinvestment needs are minimal compared to most industries. The other key factor to look for during inflation is pricing power. Now, I'll be the first to admit, evaluating a company's pricing power is more of an art than a science. But here's one helpful exercise. Imagine a company raises prices by 10%. How would customers react? Their reactions would likely fall somewhere on a spectrum, from don't care, take my money, to no way, I'm not paying that. During inflation, you want to own companies on the first end of that spectrum, those that can easily raise prices without losing customers. Avoid investing in companies in commoditized industries, where price competition is fierce and margins are already thin. Finally, let's close this video with some important advice from Warren Buffett. Conclusion.
The best investment of all, I mean, if you're the leading brain surgeon in town or the leading lawyer in town or the whatever it may be, you don't have to keep re-educating yourself to be that in current terms. You bought your expertise when you went to medical school or law school in old dollars, and you don't have to keep reinvesting. And you retain your earning power in current dollars.
The best protection against inflation is to invest in yourself. If you're the best at what you do, whether you're a mechanic, lawyer, dentist, plumber, or accountant, you make yourself immensely valuable to other people. The benefit of being highly valued in a market-based economy is that you can essentially charge whatever you're worth, and your customers will be happy to pay it. So, there we have it. I hope you enjoyed this video. As always, make sure to like this video and subscribe to Investor Center, because my goal is to help you become a better investor by studying the world's greatest investors. Talk to you soon.